I got the call a month or two ago about doing the talk, and I got to thinking, what would y'all be interested in? And, a couple of topics, came to mind. I thought I'd, talk about the deeper dive on the dividend discount model. I thought y'all be really interested in that, where, D does not equal the Donald. And then I got to think, well, maybe that's not quite enough. Maybe we go a little further, into how we value stocks. And so we'd look at the efficient frontier, and we'd go all the way from your coffee can in your backyard all the way out to warp speed out on the efficient frontier. But along the way to putting this talk together, the market kind of made some news, and back on August 24th, we had a 1,000-point dive in 5 minutes. Now, y'all were probably all busy doing what you do for a living, but for what we do for a living, 1,000 points in 5 minutes will get your attention in a hurry. And it kind of disrupted my thought process about dividend discount models and capital asset pricing models. I decided I'd come in and talk to you all about market volatility, because I think that's what's top of mind for everybody today. So we're going to walk through just a handful of slides here. I'm not going to pull the Methodist preacher and ignore the clock in front of me. So we're going to see what we can learn from what's been going on in markets. So the first thing is this is the first significant decline of 10% or more in 46 months. And that's about one of the longest periods of time. And the point of that is this is normal. This is not something that's a big event that we've never experienced before. What's anomalous is the interval between corrections is more anomalous than anything else. That's not to say that there aren't issues in front of us, but for a 10% decline, it's quite a natural occurrence in the marketplace. It happens very often. What's unique about this one is how long it's been since we've had one. So let's talk about volatility for a minute. The slide here is a little busy, but this is the VIX, and this is a measure of expected volatility looking 30 days out. You can go out and buy a contract to anticipate market volatility, and it gets priced based upon, quite frankly, animal spirits, where the puts and calls are looking forward. For those of you that aren't familiar with the VIX, the important numbers on this slide is the line for 20 and the line for 30. And in our business, anything below that 20 line is considered kind of everything's okay. Nobody's really terribly concerned. Sort of puts and calls are in balance. When you get north of that 20 line, you're moving into a more volatile period. It's a great place for hedge funds to start operating above that number. And then when you get above 30, you're moving into flat out panic. And so we experienced being above that 30 line, and if you look back at history, you'll see the VIX spike back in 08, 09. You'll see a VIX spike back in 11, and you'll see another VIX spike there moving into 12. So these spikes are quite common, but you should pay attention to them because they tell you something about expectations looking forward. So something else that we look for when we see a 10% correction is, well, what's going on in the marketplace? And this is a slide of correlations of stocks in the S&P 500. How are they behaving as a group? How high is the correlation? And when it gets to close to 100%, you know that no one's really making any decisions anymore. They're just selling the market. I want out. Don't care. Let it go. The correlation is up significantly here. It's interesting, it isn't as high as past peaks. And the only thing that kind of, we conclude when we look at this correlation number is, maybe they'd already taken the energy stocks out and blasted them such that they didn't quite move in lockstep with the rest of the market. But at least there were some decisions being made in the market about what stocks we're going to own and what stocks we're going to sell versus just selling the market in general. So now those were all the nice slides. So now we're going to get into the slides where we're starting to look at more fundamental information besides the technical stuff. And so this is equity valuations, and we're really going to look at the bottom box. And the green line there is the median 30-year average of prices of stocks as measured by the price-earnings ratio. And that green line, it's hard to read, it really runs about 19 is the median number for stocks going back, I don't know, back to the 40s on this slide. And the red line is where the valuation moves. So above that green line, stocks are technically expensive. Below the green line, they're a bargain. And you can see they, except for some extended periods there, they very rarely live below that green line. The market's really adopted a behavior of pricing somewhere around that median. But as you can see, we are well above that median number. So fundamental stock pickers look at this market, the S&P 500, and they'll tell you it's expensive. So what is going on the earnings side of the price-earnings ratio? So this is a year ago, the consensus on the Wall Street analysts said that we're going to have 10% growth in the S&P 500 earnings. Today, it's no growth. Now you can break this down and say, okay, is there anything about this that, is there a ray of sunshine in here somewhere? And if you take out energy, which is the red line right there, the earnings number looks closer to 7%, maybe a little better. And so that's why they weren't quite as off as you think they were, going from 10% growth to zero. I don't need to tell anyone in this room, we've had a change in oil prices. So when you look at this, the earnings don't look too good. It really backs up the prior slide that maybe stocks are a little expensive, but there is a little ray of sunshine here on earnings comparisons going forward. Perhaps for the energy companies are going to look a little better. I realize we're going to have some hedges rolling off here, but in the publicly traded securities, that should be known. So what else do we look to? We look to credit. And if you look at credit spreads, whether it's the high yield, which is the top red line, or we look at just the investment grade credit, which is the black line, those numbers are moving up. The spreads are widening. And if you look kind of below that at the S&P 500 or the Russell 2000, they're clearly paying attention to the widening credit spreads. It's often a warning sign if you look through history, credit spreads widening, bad for stocks. The last happy slide in the group is the commodity super cycle is over. So this is a basket of commodities. It's a CRB commodity index. It's about 40% energy, about 40% ag. But I will tell you, if you pull the numbers for aluminum or copper, those numbers are going to be 40 and 50% off their peaks. So it is across the commodity spectrum. This is a very strong indicator of global demand, if you ask us. I realize there's big supplies in copper. I realize there's a supply in energy. But when we look at out there through Kanaly's lenses, this is kind of a hard slide to ignore that, there are some fundamental changes that have been going on for some time in this marketplace. And so what are we thinking? We're thinking that this is a perfectly natural repricing in the S&P 500. We're thinking that in emerging markets, it may have a ways to go. It's time to be thinking about what the risk profile is in our clients' portfolios, and we've made appropriate shifts there. Do we think this thing is going to roll over? No. Does it have another bottom to test? Quite likely, and that'll be true for the commodities. That'll be true for the S&P 500. The emerging markets are going to kind of make their own news for a while, but it's a time for caution. So the last word, and I'll stop. The Federal Reserve is going to meet this week. They're going to make a decision about getting off zero interest rates. you hear commentators talk about this all the time. The Fed's been very clear, it's not an if, it's a when. And so it's either going to happen this week or it's going to happen in December. They've made that very clear. They've got to meet market expectations. The smart move would be for them to do it, which I believe they will. I don't know that that's widely held at our firm, or on the street for that matter. But they're probably going to do something. It'll be the marginal language that they discuss about what their moves will be going forward and what they say about what they see in economic cycles. So that's going to be very, very important on Thursday of this week. And if you look at the market behavior this week, it is a show-me market. They are waiting for that announcement and what that language will be on the margin. Thank you.